All right, so learning objective 2 tells us how to do adjusting entries. Again, the word entry means that you're putting it in the journal. If you're putting it in the journal, it's going to travel, right? You're going to post it to the ledger, which means that the balances in those accounts that are affected are going to change. Blah, 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 blah. All right, so again, to defer, again, means to postpone or to delay. And there are only 4 deferrals that you're going to have to learn from this book, and they're all outlined right here. So deferrals are looked at as either what we call a prepaid expense, which are basically assets that once we use them, turn into expenses, or unearned revenue, which of course is quite easy, right? Unearned service revenue means we owe the client something they paid for. But what happens after we deliver, right? After we give them the good or service that they paid for, it's no longer unearned. It's actually earned, which means it no longer belongs on the balance sheet. It belongs on the income statement. Same thing, right? After these prepaid expenses start as assets, supplies as an asset. But after you use up that asset, it becomes supplies expense. In other words, it belongs on the income statement. So this is part of the what we call adjusting entries, these deferrals. So let's take a look at the 4 that you need to know. Of course, they introduce you to prepaid expenses. So again, you are paying for these in cash, but after they are used, so they start as assets, after they are used or consumed, they can be expensed. So these are all the different types of, believe it or not, and you haven't heard of some of these, like the advertising rent. So there's prepaid rent, just like there's prepaid insurance. There's prepaid advertising, just like there's prepaid insurance. Of course, you don't have to worry about these right now, but just to know that those are really accounts in accounting. Prepaid insurance, prepaid rent, prepaid advertising are all current assets. Supplies, as you also know, is a current asset. When we buy them, they're supplies. But when we use them, we have supplies expense. And of course, you know, property, plant, and equipment, the buildings and equipment would be long-term tangible assets under the property, plant, equipment classification. And these babies are the ones that depreciate over a long period of time. So the expense is small, but they happen for many, many years. Okay. Where prepaid insurance supplies, they're expensed as they're used. Okay. And you can use a lot of them one month and not so much of another month, particularly for supplies. So they might change. Okay. So again, as the deferral piece is because you have to wait, right? The passage of time must happen before you can say it's an expense. You can't expense supplies when you buy them. You have to use them first. Well, if you're going to use supplies, that's going to take some time. Again, the shortest period of time we measure is a month. So we're going to be doing this at least month to month. So the entry that you're going to be putting into the journal is you're going to be debiting the expense because you're going to have a supplies expense or an insurance expense or a depreciation expense. And you're going to credit the specific asset account. So you would credit the supplies account to show that these supplies are no longer there, they've been expensed. Okay. So you're going to see how that works. But this is you're going to debit the expense, credit the asset that's affected. So again, your first thing that you're going to be, the first one you're going to know is how to do that for supplies. This is on page 157. And these are already done for you. So it's not like, you just have to review them and make sure you understand them. So remember, Sierra Corporation, very early in October, bought $2,500 of supplies. So at the beginning of October, they had $2,500 of supplies. However, at the end of the month, which was October 31st, they only had $1,000 of supplies left. So on hand is a term that they use to say what's left. So if you started with $2,500 of supplies, at the end of the month you counted and you only have $1,000 of supplies left, you've used the rest, the difference. You've used the difference. So whatever you have used can be expensed. And so in this case, we're going to have the entry is going to be a debit to supplies expense and a credit to supplies. Again, you can only expense what you've used. But in order to use it, you're going to have to wait to count at the end of every month in this case. Once you put this in the journal, this is how it posts out in the ledger. Whatever goes in the journal is going to post in the ledger, as you know. So when you see that posted in the ledger, you will see it with something called an adjusted entry. So you'll see the ADJ indicating it's an adjusting entry that happened. And you'll also tell that by the date. Anything that happens on the last day of every month is oftentimes going to be an adjusting entry. Okay. Not all the time. Certainly things happen on the last day of every month. But in this case, this is the very end. Very end. Here's your second entry that you have to know. This is on page 158. 158. We buy insurance, right? That's prepaid insurance. So in this case, Sierra Corporation had $600 one-year insurance policy that they bought. Now we're at the end of October. So in other words, we've used up, this is a one-year policy, so that's 12 months. We've used up at the end of October 1 month of the 12 months. So in other words, $50 of the $600 insurance policy has been used for the month of October. So we can expense the 50 bucks. Okay. And so the entry would be a debit to insurance expense, showing we've used that. Crediting prepaid insurance simply lowers the amount of prepaid insurance we have left, right? Because when you use it, you just don't have that much value left, right? So it's going to go down by a little bit every single month in this case. And then, of course, that's the journal entry. Once that gets transferred into the ledger, you'll see prepaid insurance with the adjusting entry, which means it also has a new balance. This asset has a new balance. And insurance expense now has a balance. It didn't have one before. But because we used some of this, we can expense it. How exciting. Here's your third one. This is talked about on the bottom of 158 and in 159. So it's important to make sure you have that reference as well. So again, buildings, equipment, motor vehicles, property, plant, and equipment for the most part, right? They are assets. They are assets. But once we actually, and they're assets because they're going to be using them for a long period of time. Okay. So there's a process of basically allocating the cost of these assets like buildings and equipment and motor vehicles to what we call a depreciation expense, depending on how long the business is going to use them. And so again, motor vehicles don't last forever. They might last, say, for example, a delivery truck, you might say we're going to use for 4 years. Well, that's its useful life. You can only depreciate it over the 4 years you're going to be using it. Okay. A useful life to the business, not to the vehicle itself, but to the business. And so more on this in chapter 9 for sure. So we can allocate a portion of the cost to something called depreciation expense. Okay. And again, every month, every quarter, every year, we're going to see this. So in this case, it works a little bit different than the other expenses that you just saw. Depreciation for office equipment is usually given to you. So this is $480 a year. In other words, $40 a month, this office equipment will be depreciating. So the depreciation expense for every month will be that $40. The interesting thing about depreciation is the office equipment account is not directly affected. what we do is we put together a sort of a buddy account to it called accumulated depreciation for the equipment. Accumulated depreciation for the equipment shows how much of the equipment has been expensed over time, because it'll simply accumulate over, in this case, because it's a long-term asset, over the years. It'll continue to accumulate in the account. Accumulated depreciation for equipment is technically an asset account, but it has a opposite balance. It has a credit balance instead of a debit balance. So it's called a contra asset account. And it always will be piggybacking the equipment account. So again, even though we've used a portion of this equipment, we don't credit the equipment account like we do supplies or insurance. That's because equipment is a long-term asset, property, plant, and equipment. So instead, we've created another account called accumulated depreciation on that equipment. It follows the equipment account in the ledger, and it basically shows us how much of the equipment we have used. In this case, since Sierra Corporation has only been in business for October, that's the accumulation. But you will see this, you will see this happening every single month. So it'll keep accumulating. Okay. So again, the book explains to you that the accumulated depreciation account is something called a contra asset account, which means it's an asset account with an opposite balance. The word contra simply is an opposite balance account. So asset accounts have debit balances, but accumulated depreciation for equipment will have a credit balance. That's what makes it a contra asset account. The actual value on the balance sheet of the equipment is called the book value. Book value. So we do have a $5,000 piece of equipment that we purchased, but we have used $40 of that has been expensed. So accumulated depreciation is then basically used to subtract out the value of the equipment, meaning that the $49.60 at the end of the month is the book value of the equipment that you would see on the balance sheet. Okay, and this is just sort of a chart that goes over this. The fourth deferral that you're going to be learning about is unearned revenue. Unearned revenue means, as you know, you received cash from the client ahead of time, and you recorded it as a liability. Why did you record it as a liability? Because you owed those clients whatever they paid for it. It happens to a lot of companies. There's a lot of unearned revenue for landlords that might collect rent up front. Airline tickets, you usually buy it for a future flight. So when you buy it up front, it's an unearned ticket revenue. Magazine subscriptions, tickets to anything else, customer deposits on vacations, cruises, what have you. Not that you want to take a cruise these days, but just saying those would be unearned revenue. So it sits in the unearned revenue account until, of course, you've delivered, right? Once you deliver, that becomes your revenue. It's no longer a liability. You've actually earned it. So the adjusting entry, what goes in the journal is we're going to actually lower the liability. We lower liabilities on the debit side, and we're going to increase our revenue with the credit side, because now it's ours. See, unearned revenue, the word unearned means we owe it. But after we deliver for whatever they paid for, it becomes an earned revenue, which is what revenue is. Okay. So here is an example. Remember that we received $1,200, Sierra Corporation received $1,200 from RNOx for guided services performed. Okay. Well, during October, the company actually performed $400 of work for RNOx. So do they still owe this guy $1,200. No, they already performed 400 of that 1,200. So that $400 becomes what we call an adjusting entry. We have to take it out of the liability, which is why we debit unearned revenue, and we credit revenue. It should be revenue now. Okay. Remember, unearned service revenue is on the balance sheet. Service revenue is on the income statement. This is ours. We've earned it. Should be on the income statement now. So after this adjustment, which is in the journal, this is how it would post in the ledger. Unearned service revenue balance would be reduced now because we earned 400 of that. And service revenue would be adjusted up because we've actually earned more of that. So these are the 4 adjusting entries that are called deferrals. And there's only 4 of them that you have to know, and they're specifically in the book, and they work the same way all the time. So they repeat. It's a wonderful thing because these do repeat. So this is in the back. This is good to study. This is on page 162. Okay. In your book on page 162. This is good to study. The do it exercise with a solution. So here what we have is the balances in various accounts for Hammond Company. Okay. And then we're at the end of the month, the end of March. So we have to do these adjusting entries. Okay. Did we use any of the prepaid insurance? Did we use any of these supplies? Did we use any of the equipment? If so, we have to expense those and adjust the asset. Did we earn any of the service revenue, unearned service revenue? If so, we have to put that money in revenue and lower the liability. Those are the 4 adjusting entries you're learning. Okay. So here's the analysis. Looks like we used up $100 of that insurance. It looks like we only have $800 of supplies left. It looks like we have equipment that depreciated $200 that month. And it looks like we've actually earned $4,000 of the unearned service revenue. So it says to prepare the journal entries, the adjusting entries are journal entries. So again, if in this case we used $100 of insurance, we can expense what we've used. So this is the very first deferral adjusting entry that you learned. Okay, and it's always going to be the same. Every time we use insurance for adjusting entries, it's always going to be a debit to insurance expense and a credit to prepaid insurance. Always, always, always in this process. Guaranteed. Okay. Supplies on hand. So look, we had $2,800 of supplies at the beginning of March. We're at the end of March. We've got $800 left. On hand means what we have left. So obviously we've used the difference. If we've used it, we can expense it. So our expense here is going to be $2,000 supplies expense, and we're going to credit supplies because we no longer have those. So we have to adjust our asset as well as claim the expense. In this case, our equipment, they give you the depreciation. You have to calculate it. $200 for the month of March. And so we're going to show a depreciation expense for $200. And the accumulated depreciation, again, you would see this for equipment. I missed that word here, would get the offsetting credit. This is the adjusting entry every time there's depreciation. And the very last one here, looks, we owed this guy or whoever, we owed all of our customers $9,200 in whatever it is that we do. It looks like we've earned 4,000 of that. So we have to adjust that number, take it away from unearned service revenue and put it in revenue because it's ours now. And so the adjusting entry would be the debit to unearned service revenue for 4,000 and the credit to service revenue because this is we've earned it now. We've earned it now. All right, go back to our main screen for a little break and a little talk. See how you're doing.